Hi, Paul Managrasso over at CFOAttorney.com, and today is Tax Thursday, so we'll discuss audit triggers from the IRS. IRS audits concern nearly every taxpayer, but the actual triggers are much more predictable than most people realize. Contrary to persistent myths, claiming a legitimate deduction such as a home office, mileage, or depreciation doesn't automatically trigger an audit. What the IRS actually looks for are inconsistencies, omissions, and deviations from statistical norms. A taxpayer must maintain sufficient records to substantiate any deduction, credit, or income item. When the documentation is weak or the numbers fall outside the expected target ranges, that's when the IRS is going to take notice. The number one audit trigger, income mismatches. The IRS receives copies of all W-2s, 1099s, 1099-Ks, 1099 INTs, and brokerage statements. If what you report does not match the IRS database exactly, the automated underreporter system issues what's called a CP 2000 notice. Even a small mismatch, a $300 interest statement or a $50 1099 NEC will be flagged. The IRS doesn't actually have to audit when it's got the exact document proving the discrepancy. So what do? Verify every tax document and reconcile with your prior year records. Number two, disproportionate deductions compared to income. The IRS assigns every return a DIF score, that's Discriminant Information Function. This score compares your deductions to national averages for your income level and profession. A sole proprietor with $90,000 of income and $78,000 of expenses are going to get flagged because very few businesses actually operate with 13% margin. Under Code Section 162, a business expense must be ordinary and necessary, and unusual deduction patterns invite scrutiny. Number three, your cash-intensive businesses. Restaurants, salons, handymen, food truck, businesses of this nature face heightened review. Banks file a Form 8300 for cash transactions over $10,000. The IRS compares these to the tax returns. If your business claims low income and shows large cash activity, the IRS may very well initiate an examination. Number four, there's a 3-year loss rule and a hobby loss doctrine. So if your Schedule C or F shows losses for 3 out of 5 years, the IRS is going to start taking a look at whether this is a business or a hobby under Section 183. Hobby activities no longer can deduct losses. The IRS evaluates the business plan, the marketing, the time invested, the expertise, record keeping, and profitability expectations. A taxpayer who lacks a profit motive will often lose their deduction entirely. Number five, high charitable contributions. Charitable contributions greatly benefit taxpayers but require strict documentation. Under Section 170, a donation over $250 requires a contemporaneous written acknowledgement. Non-cash contributions over $5,000 require a qualified appraisal. When a contribution exceeds 10 to 20% of income, the IRS frequently requests documentation. Not because generosity is being punished, but because the documentation is often missing. Number six, cryptocurrency. The IRS now receives digital asset transaction data through Form 1099-DA, that's a new one, and direct reporting from exchanges. All crypto transactions, sales, swaps, rewards, staking, mining, are taxable under Code Section 61. Failure to report crypto income is one of the fastest growing audit categories. Number seven, pass-through entity issues. Partnerships and S-corps have increasing audit exposure. Errors arise from basic miscalculations under Section 704 and 1367, improperly claimed losses, and unreported distributions. The IRS also checks shareholder wages in S-corps to ensure reasonable compensation under Section 3121. Example, a consultant reported $160,000 in revenue and $150,000 expenses on Schedule C. During the audit, the IRS questioned meals, travel, and marketing expenses. Taxpayer lacked receipts for 70% of the claim costs. Under Section 274D, deductions requiring substantiation, I'm having trouble with that word today, meals, travel, entertainment, gifts, listed property were denied. Because the taxpayer did not maintain contemporaneous logs and receipts, the IRS disallowed $40,000 and also assessed accuracy penalties. How do I protect myself? I hear you ask. Maintain receipts. Digital receipts are okay because of Section 6001, which now allows for electronic records. Separate your business and your personal finances completely. Track mileage contemporaneously using a GPS or a mobile app, a scrap of paper. If you put it on paper, though, put it into a log of some kind. And the key here is contemporaneously. Don't try to recreate this after you get a letter from the IRS. Maintain a written business plan for Schedule C businesses and any other businesses. Reconcile income to issued 1099s before filing. Avoid estimating numbers. Rounded amounts are generally red flags. In conclusion, IRS audits are driven by data, documentation, and consistency, not by fear. If your return matches third-party documents and your deductions are supported under IRC 162 and 6001, and your business activities show a real profit motive, you dramatically reduce any audit risk. A clean, well-documented return is the strongest audit defense ever. And remember, if there's anything that you need us to take a look at or any way that we can help before we get into the audit, be sure to let us know. Until next time, have a great day.